Something extraordinary just happened in the gold market. And if you're not paying attention, you're about to miss the most significant shift in precious metals in over 50 years. For decades, we've been told the story. Gold goes up when rates go down. Gold goes down when rates go up. It's been the iron law of precious metals investing. The textbook relationship, the one thing you could count on. Except now, that relationship just shattered. Right now, as I'm recording this, the Federal Reserve is holding rates at their highest levels in over 2 decades. We're talking 5.3% on the Fed funds rate, and according to everything we've been taught, gold should be getting crushed. Investors should be fleeing to high-yielding bonds and money market accounts. The opportunity cost of holding non-yielding gold should be killing demand. But here's what's actually happening. Gold just hit all-time highs above $2,700 per ounce. While rates are elevated, while the dollar is strong, while real yields are positive. This isn't supposed to happen. This breaks every model, every algorithm, every traditional analysis framework that Wall Street has used for the past 50 years. And the implications? They're staggering. Because what we're witnessing isn't just a temporary anomaly. It's not a blip. It's not noise in the data. This is a fundamental regime change in how gold behaves, a complete rewiring of the forces that drive precious metals prices. Let me show you exactly what I'm talking about. In September 2024, the Federal Reserve cut rates by 50 basis points, the first cut in over 4 years, and gold did rally, hitting $27.89 per ounce. That made sense. That fit the traditional model. But then something strange happened. The Fed signaled fewer cuts ahead. Rate expectations shifted higher. Real yields started climbing. And gold? Instead of collapsing like it should have, it consolidated. It held its ground. It refused to give back those gains. Fast forward to today. We've got the 10-year Treasury yielding over 4%. Real yields, after adjusting for inflation, are solidly positive. The dollar index is holding strong. And gold is trading near record highs. This is the decoupling, and it's telling us something profound about what's coming. Now, before we go further, let me explain what's really driving this. Because this isn't about technical analysis or chart patterns. This is about a fundamental shift in how the world's largest institutions view money itself. Central banks are buying gold at a pace we haven't seen since 1950. The World Gold Council just released their latest data. In October 2024 alone, central banks purchased 53 tons of gold. That's up 36% from September. And it's part of a multi-year trend that's accelerating. But here's the critical detail that everyone's missing. These central banks aren't buying because rates are low. They're buying despite rates being high. They're buying because they've lost faith in something much more fundamental than interest rate policy. They've lost faith in the dollar-based system itself. Think about what's happened over the past 3 years. The United States froze Russia's dollar reserves, $600 billion gone with the stroke of a pen. Doesn't matter that Russia had those reserves legally. Doesn't matter that they were held in Western banks following all the rules. When geopolitics demanded it, those assets were frozen. Every central bank in the world watched that happen. And they all asked themselves the same question. Could that happen to us? China's been asking that question for years. They've been steadily reducing their treasury holdings while building their gold reserves. The People's Bank of China has been buying gold for 18 consecutive months. They're not reporting the full extent of their purchases anymore, but independent analysts estimate they're accumulating at least 20 to 30 tons per month through unofficial channels. Why? Because gold can't be frozen. Gold can't be sanctioned. Gold can't be cut off from the SWIFT system. Gold is the ultimate neutral reserve asset. And it's not just China. Turkey, India, Poland, Singapore, the Czech Republic. Central banks across the world are diversifying away from dollars and into gold. Not because of interest rates, because of trust. This is the new paradigm. Gold is no longer just an inflation hedge or a rate-sensitive commodity. It's becoming a monetary asset again. A parallel reserve system, a hedge against the weaponization of the dollar itself. And once you understand that, everything else makes sense. Look at what's happening in the BRICS nations: Brazil, Russia, India, China, South Africa. They're actively working on alternative payment systems. They're settling trade in local currencies. They're building infrastructure to bypass the dollar entirely. At the BRICS summit in August 2024, they announced plans to expand the bloc to include Saudi Arabia, the UAE, Egypt, Ethiopia, and Iran. These aren't small players. Saudi Arabia alone handles over 7 million barrels of oil per day. If even a fraction of that trade starts settling outside the dollar system, the implications are massive. And what's the common thread in all these alternative systems? Gold. Not as the primary settlement mechanism necessarily, but as the backstop. The reserve asset that everyone trusts when they don't trust each other's currencies. This is why gold is decoupling from rates. Because the game has changed. The question is no longer, what's the opportunity cost of holding gold versus bonds? The question is, what's the risk of not holding gold when the entire monetary system is being restructured? Let me give you a specific example of how this plays out. In 1971, when Nixon closed the gold window, gold was $35 per ounce. The dollar was the unquestioned global reserve currency. America held the largest gold reserves in the world. The system seemed stable. But underneath, pressure was building. The U.S. was running deficits, printing money to fund the Vietnam War and Great Society programs. Foreign central banks were getting nervous. France famously sent a warship to New York to collect their gold before the window closed. When the system finally broke, gold didn't just go up, it exploded. From $35 in 1971 to $850 by January 1980, a 2,400% gain in less than a decade. Now, I'm not saying we're going to see that exact scenario play out again, but I am saying the underlying dynamics are eerily similar. We've got massive deficits. We've got money printing on a scale that would have been unimaginable in the 70s. We've got foreign central banks getting nervous about dollar exposure. And we've got gold starting to move independent of traditional drivers. The difference this time? The move is happening while rates are still elevated, which means when rates do eventually come down, and they will, we could see an acceleration that catches everyone off guard. Here's another piece of the puzzle that most people aren't connecting. The physical gold market is getting extremely tight. Not the paper market, the physical market. There's a crucial difference. On the COMEX, the futures exchange where most gold trading happens, you can trade massive amounts of gold that doesn't actually exist. It's paper contracts, promises to deliver gold at some future date. The ratio of paper gold to physical gold on the COMEX is estimated to be somewhere between 100 to 1 and 200 to 1. That works fine as long as nobody actually wants delivery, as long as everyone's just trading the contracts back and forth, speculating on price movements. But when people start standing for delivery, demanding actual physical metal, the system gets stressed. And that's exactly what's happening. Deliveries out of COMEX warehouses have been running at elevated levels for months. The Shanghai Gold Exchange, which deals primarily in physical metal, has been trading at a premium to London and New York. That premium, called the Shanghai Premium, is a direct indicator of physical tightness. When physical gold is scarce in Asia, buyers pay more. The premium widens. And right now, that premium is telling us that real physical gold is in high demand regardless of what interest rates are doing. This matters because it means the paper market and the physical market are starting to diverge. The paper market might still respond to rate changes and dollar movements, but the physical market is being driven by something else entirely, by central bank buying, by Asian demand, by people who want to hold actual metal, not contracts. And when those two markets fully decouple, when the paper price can no longer suppress the physical price, that's when things get really interesting. Let me paint you a picture of what that could look like. Imagine you're a pension fund manager. You've got billions in assets. You've been told your whole career that gold is a barbarous relic, that it doesn't generate yield, that it's not a productive asset. But now you're watching central banks accumulate. You're seeing the physical market tighten. You're reading about BRICS payment systems and dollar alternatives. And you're starting to wonder if maybe, just maybe, you should have some exposure. So, you call your broker. You want to buy gold. Not a lot, just 2 or 3% of your portfolio. That's conservative, right? But you're not alone. Pension funds across the country are having the same realization. Sovereign wealth funds, insurance companies, family offices, they all want a small allocation. Except, here's the problem. When you add up all those small allocations, you're talking about hundreds of billions of dollars trying to flow into a market that only produces about 3,000 tons of new gold per year. That's roughly $200 billion worth at current prices. The math doesn't work. There's not enough physical gold to satisfy that demand without a massive price adjustment. And that's before we even talk about retail investors. Regular people who are watching their purchasing power erode, who are worried about their retirement accounts, who are looking for something, anything, that holds value when everything else seems uncertain. Quick aside here because this is relevant. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties. Worth checking out if you're thinking about this stuff. Anyway, back to the bigger picture, because what we're really talking about here is a confidence crisis, not in gold, in everything else. Think about what's happened to confidence in institutions over the past few years. Confidence in government, confidence in central banks, confidence in the banking system itself. In March 2023, we watched Silicon Valley Bank collapse, then Signature Bank, then First Republic. The 16th largest bank in America, gone. And the response? The Federal Reserve created a new lending facility, essentially printed money to backstop the system. That worked to stop the immediate crisis. But it didn't restore confidence. It did the opposite. It showed everyone that when push comes to shove, the rules don't matter. The Fed will print whatever it takes to keep the system afloat. And if they'll do that for regional banks, what will they do when the real crisis hits? When it's not just a few banks, but the sovereign debt market itself that's under pressure? The U.S. national debt just crossed $36 trillion. The interest on that debt is now over $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare. It's becoming the single largest line item in the federal budget. And here's the kicker. That's with rates at 5%. What happens when we have to refinance all that debt at higher rates? What happens when the bond market decides it wants a higher risk premium to hold U.S. Treasuries? There are only two options: default, which is unthinkable, or inflate, which is inevitable. And when investors realize that inflation is the path we're on, that the debt can only be managed through currency debasement, where do they go? They go to gold. Not because of interest rates, because of survival. This is why the decoupling matters so much. It's showing us that the market is already pricing in this reality, that sophisticated investors, central banks, and institutions are already positioning for a world where the dollar's dominance is no longer guaranteed. Let me give you another historical parallel. In the late 1970s, gold went from $200 to $850 in just over 2 years. Everyone remembers that move, but what most people forget is what happened right before it. In 1978, gold was trading around $200. The Fed was raising rates aggressively to fight inflation. Paul Volcker was about to take over and push rates into double digits. By all traditional logic, gold should have been under pressure. Instead, it started climbing. Slowly at first, then faster. By the time Volcker's rate hikes really kicked in, gold was already at $500. And it kept going, peaking at $850, even as rates hit 20%. Why? Because the market understood something that the textbooks didn't. When confidence in the currency itself is breaking down, interest rates become irrelevant. You can't compensate for currency risk with yield, not when the currency is losing purchasing power faster than the yield can keep up. We're seeing the early stages of that same dynamic now. Gold climbing while rates are elevated. The market telling us that something bigger is at play than just monetary policy. And the really scary part? We're not even in a crisis yet. This is happening during what's supposed to be a stable period. Unemployment is low. The economy is growing. The stock market is near all-time highs. Imagine what happens when we hit the next recession. When unemployment spikes. When tax revenues fall and deficits explode. When the Fed has to choose between fighting inflation and preventing economic collapse. That's when the decoupling becomes a chasm. That's when gold doesn't just outperform bonds. It outperforms everything. Now, I know what some of you are thinking. This sounds extreme. This sounds like doom and gloom. Maybe gold's just in a normal bull market, and I'm reading too much into it. Fair enough. Let's look at the data objectively. Gold has outperformed the S&P 500 over the past 5 years. It's outperformed bonds. It's outperformed real estate. It's one of the best performing asset classes of the past decade, and most investors don't even own it. The average portfolio allocation to gold among institutional investors is less than 1%. Among retail investors, it's even lower. Most people have zero exposure. But central banks? They're at 7% and climbing. Sovereign wealth funds are increasing allocations. The smart money is moving. And here's the thing about paradigm shifts. By the time everyone recognizes them, it's too late to position for them. The move has already happened. In 2008, everyone knew real estate was overvalued, but they kept buying because prices kept going up, until they didn't. And then it was too late. In 2000, everyone knew tech stocks were overvalued, but they kept buying because prices kept going up, until they didn't. Right now, everyone knows the dollar system has problems, but they're not acting on it because the dollar is still strong. Rates are still elevated. Everything seems fine, until it's not. The decoupling we're seeing in gold is the early warning signal. It's the canary in the coal mine. It's telling us that the relationship between gold and rates has fundamentally changed because the underlying system has fundamentally changed. And once you see it, you can't unsee it. Think about the mechanics of what's happening. When central banks buy gold, they're not doing it through the futures market. They're buying physical metal, bars, coins, actual gold that gets shipped and stored in vaults. That gold comes out of the available supply. It's not being sold back into the market. It's being held as a strategic reserve, which means the available supply for everyone else is shrinking. At the same time, mine production is basically flat. We're not discovering major new gold deposits. The easy gold has been found. New mines are deeper, lower grade, more expensive to operate. Production costs are rising, which puts a floor under prices. So you've got shrinking available supply from central bank buying, flat production, rising costs, and now potentially a wave of institutional and retail demand as the decoupling becomes more obvious. That's not a recipe for a correction. That's a recipe for a moonshot. And the timing couldn't be more critical, because we're heading into an election year in the United States. Fiscal policy is going to be expansionary regardless of who wins. Both parties have shown they're willing to spend without restraint. The deficit is going to widen. The Fed is going to be under pressure to keep rates low to make that debt serviceable. But if they cut too much, inflation comes roaring back. If they don't cut enough, the economy stalls and tax revenues collapse. It's a trap, and gold is the escape hatch. Here's what I think happens next. The Fed cuts rates at some point in 2025. Maybe not as much as the market wants, but they cut. And when they do, gold doesn't just rally, it explodes. Because all the investors who've been waiting on the sidelines, who've been told that gold can't go up with high rates, suddenly realize they were wrong. They realize the paradigm has shifted, and they panic buy. We could see $3,000 by mid-year, $3,500 by year-end. And if the dollar really starts to crack, if confidence really breaks, $5,000 isn't out of the question. I know that sounds crazy. But go back and look at what gold did in the 70s. From $35 to $850. That's a 24x move. If gold did a quarter of that from current levels, we'd be at $17,000 per ounce. I'm not predicting that, but I am saying the potential is there if the system really breaks down. And even if it doesn't, even if we just see a normal bull market continuation, gold at $3,000 or $3,500 is very achievable based on historical patterns and current fundamentals. The key is understanding that we're not in a normal market anymore. The rules have changed, the correlations have broken, and the investors who recognize that early are going to be the ones who profit. Let me give you one more piece of evidence that this is real. Look at what's happening in the mining sector. Gold mining stocks have been lagging the metal itself. Normally, when gold goes up, mining stocks go up even more because of leverage. But that hasn't been happening. Why? Because investors don't believe the move is sustainable. They think gold is going to come back down when rates stabilize, so they're not buying the miners. But what happens when they realize the move is sustainable? When they realize this is a new paradigm and gold is going higher regardless of rates? The mining stocks are going to explode. We're talking about potential triple-digit gains in quality producers, because they're priced for gold at $2,000, not gold at $3,000 or $3,500. That's the opportunity. Not just in gold itself, but in the entire ecosystem around it. Miners, royalty companies, streaming companies. They're all mispriced for this new reality. And the beautiful thing about a paradigm shift is that it takes time for everyone to catch on, which means there's still time to position, still time to get ahead of the crowd. But that window is closing. Every day, more investors are noticing the decoupling, more analysts are writing about it, more institutions are adjusting their models. At some point, this goes mainstream. At some point, CNBC is talking about it every day. Bloomberg is running headlines. And by then, gold is already at 3,000 or higher. So, here's what you need to understand. This isn't about timing the market. This isn't about trying to catch the exact bottom or top. This is about recognizing a fundamental shift in how the world works and positioning accordingly. Gold has decoupled from rates because the world has decoupled from the dollar system. That's the real story. That's what's driving everything. And once you see it that way, the path forward becomes clear. You don't wait for confirmation. You don't wait for everyone else to figure it out. You act now, while there's still time, because the new paradigm isn't coming. It's already here. The decoupling has happened. The only question is whether you're going to recognize it in time to benefit from it. This is the most significant shift in precious metals in 50 years, and it's happening right now, in real time, whether you're paying attention or not. The smart money is already positioned. Central banks are already buying. The physical market is already tight. The only question left is, what are you going to do about it?